Great. Well, thank you for joining us. It gives me great pleasure to introduce our distinguished presenters, Michael Desmarais III and Michael Katchen, who generously agreed to join us today. Paul is the chairman and CEO of Sagard Holdings, executive chairman of Portage 3 Ventures, a senior vice president of Power Financial and Power Corporation, chairman of Wealthsimple and Peak Achievement Athletics, and vice chairman of Imerys. Wow. Previously, Paul was with Great West Lifeco, as well as Imerys in France and Goldman Sachs. Paul holds degrees from Harvard and INSEAD. His dialogue partner today, whom I'm sure most of you know, will be Michael Katchen. Michael is the co-founder and CEO of Wealthsimple, a leading financial service innovator operating in Canada, the US, and the UK. Michael started his career at McKinsey Company, where he advised clients in finance and technology. He founded Wealthsimple in 2014 and has been called an industry mover by Financial Post, a change agent by Canadian Business Magazine, and one of Toronto's 50 most influential people by Toronto Life. He won Entrepreneur of the Year at the Canadian Startup Awards and Tech Vibes, and was named one of Canada's top 40 under 40. And by all accounts, he's just getting started. Ladies and gentlemen, please welcome me in joining Paul and Michael.
Awesome. So thank you so much for being here. Michael and I actually do this on a regular basis as part of a program called Next 36 and CDL. And our partnership is a topic that we like discussing a lot because it's actually quite unique in the Canadian landscape. From my standpoint, and Michael will have some more kind of interesting takeaways, but I think if there are kind of two interesting takeaways that you could take from our talk today is, one is that disruptors like Michael can take on an industry and provide a higher quality service at a much lower cost and access demographics that large companies like Investors Group, RBC, whatnot, don't necessarily can access. And two is that for companies and groups like ours to partner with companies like Michael, it takes work to form a partnership. It's not, an obvious thing that, you could do and not kind of work on it. And I think, we're in our fourth year of partnership, and it's something that's required a lot of work. And I think over the course of the talk, we'll try and flesh out some of the things that kind of drove that and kind of, might be interesting to many of you. Are many of you customers of Wealthsimple? Any customers in the room?
Thank you for your business. We got our work to do, though.
Well, Michael, maybe if you start with the story of, why Wealthsimple, how that started, what mission did you set off on, and, why did you end up seeking out a partner?
Happy to. I grew up here in Toronto and was lucky enough that when I was 12 years old, my sister entered me into a stock picking contest for charity. And I went on to win the contest by betting on a stock that in the heights of the tech boom was up 250% in 8 weeks, and took my dad skiing for a week in Whistler as a 12-year-old kid. I thought I was the coolest 12-year-old kid around. But it taught me to love investing. And if I fast forward many years, I was living in San Francisco, where a startup I'd been working at was just acquired, and the team I was working with made some proceeds for the first time in their lives. They wanted to invest. And they all knew I liked to do it, so they said, Mike, help us figure this out. And my belief at the time was it's so easy to manage your own money, especially if you're dealing with smaller, people that are just getting started. You build a portfolio of ETFs, you rebalance it, you're off to the races. I built a spreadsheet in Excel that showed you how to do exactly that. And the feedback I got from this group of friends was, Mike, we love the approach, but we're lazy. Just do it for us. And they became the inspiration behind Wealthsimple, which was, here was this group of people that were smart enough to know they should be investing, but didn't really want what the industry was offering. They didn't have millions of dollars to go access a very high net worth shop. They didn't really want to pay, what would be 2% for a mutual fund. And they wanted someone to make it really easy for them. And we decided to tackle that problem, and we've been iterating ever since. And we've been fortunate in the last 5 years. We've built a business today that has about 200,000 clients in Canada. We manage about $6 billion. And I think the most exciting part about our business is that in the last 18 months, we've started to expand beyond being just an investment company and really set out on a mission to help make sense of people's finances more broadly. And so we've launched a savings account, a trading app that lets people invest their own money, and most recently acquired a tax prep business, which is obviously another big, complicated, important part of people's finances. So we're on this mission of making people's finances easy and accessible, and Paul and Power have been incredibly important partners to us along that journey. I think one of the things we realized quite early when Paul and I got connected was that the mission that we're on is one that's going to take us decades to achieve. I think a lot of people think about disruption as this thing that happens overnight, and you hear all the time about these amazing technology success stories of these fantastic growth stories of billions of dollars valuation created in days or weeks or months. That's not what we're trying to do. We're trying to really change the industry, and it's going to take decades to do that. And we knew having a partner like Paul and Power that had the long-term time horizon to support what we were trying to do would be an important ingredient to get there.
And talk to us a little bit about how you structured the company in the early days in order to attract a group like ours. Who did you surround yourself with? Because ultimately, very quickly you had some kind of brand name individuals around you that, were, there was a strategy in that.
Yeah, I mean, when we launched this company, I had never worked in this industry before. And you can imagine what the story was like on day one when we launched the company. I'd go out and I'd do events, and I'd try to sell people on, we're offering a really high quality investment service at a low fee. We're using technology to make the whole experience simple. People say, well, that sounds fantastic. How many clients do you have? Well, if you sign up, we'll have one. Nobody wants to be the first client of a wealth management business. That's a really tough spot, especially when the founder is 25 years old at the time and never worked in wealth management. And so we knew that a big part of what we were trying to do, beyond features and the technology experience, was about how do you build trust? Because ultimately what we ask people to do is trust us with their life savings, and it's an enormous ask. And I knew that just myself and just a product would not be able to do that. And so we deliberately set out to kind of put together an early round of financing that included folks that had built really world-class financial services firms before. So folks like Sam Safe, who was a big ETF pioneer in Canada, Joe Canavan, who was the former CEO of Asante Wealth Management, and a whole group of others that we thought had real credibility in the industry. And we did that because we thought it would help us build trust as we were just getting going.
Super. How many of you here are part of family offices that still own operating companies? So a good group of you. So, I mean, our holding, Power Corporation, has kind of two main assets, Investors Group Management and Great-West Lifeco. And when I joined the holding in 2014, and this is kind of the story of how we ended up connecting, the CEO of our holding, a guy called Jeff Orr, calls me into his office and he says, Paul, someone tells me that people might buy ETFs and mutual funds online someday. Can you tell me if that's going to be true? And, I'm like, wow, that's a really interesting question. Like, I don't know,
What's the internet?
What's
Sorry,
the internet?
Just kidding.
Yeah, well, actually, what's funny about that is my first answer was like, Jeff, I know nothing about technology. I come from mining and I come from insurance and I did some banking. Like, there is no way this makes sense for me as a project. And so effectively, I did like what all large groups do. I called Bain. And Bain, charged us a few $1 million to kind of answer this question. And they did a tremendously good job at answering the question. And so about 3 months later, after working with Bain, the conclusion was like, my God, Canadians are going to buy investment products online. And we looked at our group and we were like, well, that's a little complicated for us because we really deal exclusively with advisors. But ultimately what we were able to do is go back to like our core mission as a group and as a family, which is that financial advice is good for Canadians. And we did a lot of work showing about Canadians that are advised end up retiring with 2.5 times more assets than Canadians that are not advised. And that was a really important fact because as a group, we believe in financial advice. We don't necessarily believe that advice has to be driven by an advisor. And so that gave us the leeway to explore this new model. And at first, the idea was let's build our own. And so did as large groups do. I called up the consultants. I said, hey, we want to build our own kind of thing. And they were like, oh, that's a great idea. You're so smart. If you give us $20 million, we'll put together a business plan for you. And I sat there and I was like, well, that's not a crazy idea. That sounds right. And just at that time, I randomly met Sam Saif, who was one of the early partners of Michael. And we met actually at the Toronto Art Fair. And we agreed to have lunch the next day. And Sam and I had lunch. We spoke about what we thought of the industry. I told him about this project I was thinking of working on. And he said, look, Paul, you should walk down the street with me and kind of go meet the startup. And so we went over, and Michael was sitting in this room with 4 other people. They just launched their product. And Michael and I immediately had a connection with Michael, and that the mission that he was on was one that was like pure for the benefit of Canadians. He was not dogmatic. He'd surrounded himself with an excellent team. There seemed to be really good advisors around that ecosystem. And ultimately, the kind of conclusion I came to was like, I could either give these consultants $20 million, or I could give this guy $10 million, and it's kind of half price, and it's going to give me the same thing. And so as crazy as that sounds, that's kind of how the partnership began. And what was interesting about the beginning of that partnership is that it took us about 4 months to negotiate the deal. And Michael and I were on the phone continuously because we basically negotiated a 3-year deal where we would be the capital providers for Wealthsimple. But what was fascinating is that once we negotiated a deal, it took us about 2 months to negotiate the press release, because many of our group companies were so concerned of an announcement that this was going to happen and that Power Financial was going to go into the direct advice business. And what was fascinating about that was ultimately the discussions that we had as a family, the discussions we had in the executive team at Power Financial, where ultimately the bet was, hey, we're going to put $200 million into this company. If it works out, it is amazing. And ultimately, we will own the most disruptive kind of company in the wealth space in Canada. If it doesn't work out, it's ultimately about 1% of our NAV, and it really doesn't matter, because we'll still own Investors Group, we'll still own Great-West Lifeco, and things will be just fine. And as a family, we thought, hey, if as a family we're committed to this holding, it's extremely important for us to take bets that may disrupt our industry, may not disrupt our industry, but it's very important for us to be all over this, because if we're not, someone else will be. And that someone else will likely be one of our big bank competitors or things like that. So that's generally how that came about being. What were your kind of original kind of thoughts? You were very courageous in kind of jumping onto this deal, because you were 5 people in a room, this big machine comes by, all of a sudden you're negotiating a press release, wondering like, what in the world is this? How did you get over that hurdle? And what are some of the lessons learned for kind of families here that are kind of thinking about partnering with young startups, people that are entrepreneurs to kind of dynamize their businesses?
I think that Paul has a lot to do with why this has worked out. And what I was struck by early on when Paul and I were getting to know each other was commitment to what we were trying to do and this mission behind our business. And also the time horizon, which I already mentioned, but maybe I'll talk a little bit more about. Paul wants to be in his family business for the remainder of his life, and will want his kids someday to be in the family business. And as a founder who is trying to build a business that I hope will be around forever, it is a very unique thing to be able to partner with someone like that. I had just come from building a business in California where we were raising venture capital. And while venture has a wonderful reputation for all sorts of good reasons in tech, it has a lot of really bad consequences too. If you are going to build a business that might take longer than 7 to 10 years to get to scale, it's a terrible business for you. The way the model works, and unfortunately, most founders don't understand the economics of a venture capital model. They don't understand what kind of growth they need to achieve to pay back a fund. And if they're not achieving that growth, venture will force them to change their business, to pivot, to move away, even from things that are working, if it's not going to be the thing that can pay back the fund. And so I think for us, coming off of that, which is one of the reasons we ended up changing our business in California and ultimately worked out, but wasn't exactly what we had set out to do, the prospect of partnering with a family to really achieve this mission of making financial services more accessible to people through technology over the decades ahead was an incredibly unique opportunity and something that was really exciting. And also, the quantum of capital that Paul was prepared to invest. This wasn't we're going to dip our toe in the water and see what happens. It was we are going to really invest in making this thing work. And by the way, we're not going to invest in making this thing work by buying you and telling you how to run the company. But we're going to be your partner, and we're doing this because we trust you. And we're going to be here to open up our network, to be helpful. But we absolutely are trusting you and believing in you, which is why we're here at the table. And that's been, I think, one of the things that's made this work really well, is that Paul has never tried to step into the operating kind of role at the company. We don't have teams of folks from Power and IG that are stepping into the day-to-day way. We feel like an autonomous business. And I think that's been one of the special things that's enabled us to do what we're doing in the context of this relationship.
And what Michael just said is actually really important, because one of the biggest failures of large groups or even small groups trying to become innovative is that, all of a sudden you pass a certain threshold of ownership and your legal department is like, wow, we now own more than 50% of this company. They should sign our policies and procedures. And then you go through the policies and procedures and it says, we will not hire any company that has existed for less than 3 years. And you're like, wait a minute, how does that make sense? We just founded this company 12 months ago. Nearly every app we use is brand new. And you quickly realize that you're in a world that makes no sense. And every central function kind of wants to get their grip into these companies. And that's ultimately, I think, very dangerous for innovation. And one of the ways that our group has managed to keep being innovative is that we've created a lot of governance hurdles that make it very hard for our group companies to get involved in certain things we do. And so, we've launched our venture fund, Portage. Portage has 28 institutional partners. That makes it effectively impossible for one institutional partner to have any influence on the portfolio, but at the same time, you end up getting a lot of the benefits from that innovation in that you're seeing new concepts, you're creating new concepts, you're bringing everybody around the table to partner, but you're avoiding the compliance department, legal department, all of these big, heavy corporate functions that are paid to basically be roadblocks to innovation often. I mean, our compliance and legal hates when I say that, but the reality is that that's their role. And in a place like Great West, where you cannot afford to make a mistake, that's a really, really important role. In a place like Wealthsimple, where if you're not risking and taking risks and learning from those risks quickly, having corporate functions that stop that innovative dynamism is actually a major risk in itself.
Yeah, I think the other way to think about that is Paul Graham, who's the founder of Y Combinator, one of the preeminent startup accelerators in the world, says startups are by default dead. And so the way you operate when you are by default dead is very different than in a legal compliance function that is designed to manage risk of a highly mature, highly profitable enterprise. And trying to bring those things two things together does not work if you don't kind of create the right space and autonomy.
How do you see the future of the industry evolving? Like, the people in this room are obviously extraordinarily wealthy, probably not the core Wealthsimple customers. Do you think someday you'll have a service for them? Are we going to put Mo out of business? What are you planning long term at Wealthsimple?
Well, I think I heard, unfortunately I wasn't here this morning, but I heard Michael Hyatt was speaking, and Michael said every industry is a technology industry and every company is a technology company, and I think that that's absolutely true. I think for a long time people saw the technology sector as this other thing that was coming to disrupt them. The reality is technology is and has always been an enabler, and it should be an enabler for each and every one of our businesses in this room. And I think it will be a disruptive force for those that do not understand that and don't embrace it. And I think it is absolutely going to play a role in the ultra high net worth and the high net worth business over the years ahead. And certainly what that is probably quite different than the way we're serving a retail core audience today. But absolutely, people want the convenience of being able to do everything on your phone. The value of in-person meetings all the time as the only way to get business done is not something that a young generation is looking for. And so finding different ways to engage and meet expectations is going to be an absolutely important part of how you build relationships with clients and you continue to do business. And I think that's why we would say, hopefully, we are a partner to a lot of the firms that are trying to build businesses that take advantage of this technology as a way to better serve their clients, bring their costs down, manage all the administration and work that can be automated with machine learning and all sorts of other technology today, so they can focus on high-value activities. And that's the value prop that we're trying to bring to market, is automate everything that you don't need to spend time on, so that when especially advisors and those out there are spending time with clients, it's only on the things that really drive value in that relationship.
It's funny because on this technology as an enabler, I was just at a conference for 2 days where someone spoke about how every company in the world will be a fintech company within the next decade. And what was interesting about that is that it touched upon the fact that more and more companies around the world are basically using banking services to promote their clients. If you have any form of online good that you're selling, checkout services like Klarna, Affirm, are becoming a core part of your business model. If you have trade receivables, your ability to finance those and set up systems to basically, finance your suppliers through things like C2FO, very interesting. There's tons and tons of services. We've just invested in a company that allows food delivery people for Foodora to basically swipe on and off insurance services based on their uses. And what fascinated me is, in my seat owning, Bauer hockey skates and Easton baseball bats, is we've just launched our online presence. And in the last year, we were having a 1 to 1.5% conversion rate on our website as people came to buy skates or baseball bats. And then all of a sudden someone clicked and said, hey, why don't we offer some financing on the site? And so we partnered with Klarna, and all of a sudden our checkout rate, our sell-through rate went up by 0.5%. And what's amazing is that 0.5% is a major difference. And what we're seeing broadly in the economy is there are more and more of these solutions that will enable everybody's businesses to think differently about financing their suppliers, financing their customers in a very dynamic way. We could take some questions. I think we have about 15 minutes left, but are happy to answer basically any questions either on our partnership, on our individual businesses, our individual lives, the rest of our portfolio, whatever you want, we're happy to answer.
So Mike and the Wealthsimple team are managing the new age form of wealth management while you sit on the side of the traditional Power Corp business. So how do you manage the two, sort of the new age versus what you guys have?
Yeah. So it's interesting because in North America, our businesses at Power are a lot of kind of advisor-based wealth management, and then the businesses I run are basically all of our alternative investments through the Cigar Holdings brand. It's really a game of segmentation. When we did that Bain study, what we found is that there was about 500 to 600 billion of Canadian assets that were basically being advised by channels, service channels that were not well suited to those people's needs. And a solution like Wealthsimple was going to be able to create a new form of choice for a lot of people that are not being serviced in the ways that they ultimately want to be serviced. What's interesting about that segmentation is that the Wealthsimple offering and our Investors Group offering has extremely minimal overlap. Something like 97% of customers that open a Wealthsimple account have never touched the Power Financial ecosystem before. To drive that really home for you, we did a survey of our Investors Group customer base recently, and over 50% of our Investors Group customers would not trust a service provider that does not have a branch in their village. And so it's a totally different way. Over 70% of Investors Group customers go into a bank branch every month. And so it's a totally different world that is not the world that, you know, urban, educated, professional services millennials live in, which tend to be a pretty big demographic of the Wealthsimple customer base. And we see this across our portfolio companies is, you know, really understanding customer segmentation, who are you trying to serve, is becoming more important than ever. And my advice to a lot of our group companies and to all financial institutions that are incumbents is, if you want to survive for the long term, focus on developing products that are designed for the demographic you are trying to serve and that you are well suited to serve. If you try and go after the Wealthsimple customer base, you're going to lose every day of the week. And not only are you're going to lose against that segment, but you're probably going to lose your core segment as well, because you're going to be distracted trying to be someone who you're not.
How do you think of business plan in a 30 or 40 years life cycle? Because, you know, I think back when I was 20 years old, I didn't have any money, but I had a little bit of money from the rest, and I can understand how to try. And your space is fantastic, because I get these questions in G3 and G4 and families all the time, right? Where do I put my $12,000? But now that I'm a little older, probably still don't have any money, but my investment horizon, my sophistication is so much bigger, right? How does your platform grow how do I become a lifelong customer of yours? And what are you thinking about?
You know, it's funny, we've actually recently been spending a ton of time on this. You know, the first couple years of the business was that problem of no one wants to be the first customer. Can we just get 10 customers today? And then it was, can we get 100 and then 1,000? And now we have quite a lot of customers. And our opportunity is to continue growing our client base substantially from, you know, what is hundreds of thousands today to millions over the years ahead, and then increasing the sophistication of what we do so they want to stay with us for their entire lives. And I think the exciting and fascinating part about our business is, like Paul was saying, it's a generation that today is not well served by banks. And in fact, banks don't really have a model that can profitably serve them. You know, when you have a retail branch network, when clients don't have, you know, hundreds of thousands of dollars or millions of dollars, and they only have tens of thousands, the economics break. And so doing it through online services is actually the only way to build a model that works. And so our opportunity is to go out and acquire all these clients and then teach them to be investors and get more sophisticated in the way we service them over time. And I think that's why recently we acquired this tax business, because ultimately a huge part of planning long term and a huge financial, you know, point of friction in people's year is tax time. And so how do we take another really important time of the year and insert that into the relationship we have? How do we take the data that we can collect and learn through that part of someone's life and use it to inform even more sophisticated advice that we can offer? And ultimately, that's what we're trying to do, is continue to expand the suite of services we offer our clients, expand the sophistication of that offering so that they will never want to leave, and we can be able to serve them for the next 30, 40, and 50 years of their lives. Does that answer your question?
I think there's an element of sophistication.
Yeah. So my view on it is that, again, you have to think about segments, right? You know, a majority of the Wealthsimple customers are never going to be, you know, billionaires or multi-hundred millionaires, or even there's a handful that'll be worth $10, $20 million. Ultimately, when you think about the wealth spectrum, right? I mean, we're currently trying to serve a whole group of people whose main focus is like, am I going to have enough money to live through my retirement? You know, it's not how am I going to optimize the transfer of $100 million of wealth from one generation to another generation. That requires a ton of sophistication and a ton of products that are highly complex that are not necessarily well suited for the digital experience. That in my mind is, you know, I was saying, hey, you know, a little tongue-in-cheek, we're going to put Mo out of business. The reality is that we're not going to put Mo out of business. I mean, there is a need for advice in the ultra-high net worth space. And ultimately, I actually view this as one of the great opportunities in Canada today, because I actually think that there are very few businesses of the quality of Prime Quadrant out there, and ultimately, the people that dominate the segment today are not providing the level of service that is available in places like the US or Switzerland or other places. And there's a huge opportunity to be very disruptive in that space, but with an offer that's very different from Michael's. You know, if you just look at the asset allocation that you know people are put in when they are kind of dealing with proprietary channels, it tends to be in-house product, not open shelf, very few really quality alternatives, and we believe that there's a big opportunity there. But it's a different business model. There could be a referral agreement. If you look at Fidelity in the United States, right? They have the call centers, they have the branches, they also have their own RIAs, and then they power very large RIA offices with a technology platform. If you look at that continuum, that can end up serving a broad range of Canadians, but for now we're razor focused on a certain segment, which is not, you know, the kind of ultra high net worth segment.
What are your plans for going from 300,000 to 3 million? Once you hit the million plus, everyone is going to be looking at it.
Yeah, I mean, our goal is to continue doing what we're doing with serve clients. You know, our view is if you look at the opportunity in Canada, you know, we're barely scratching the surface. We're talking about really just getting started in terms of the opportunity in front of us. What's exciting is even within our new product ecosystem, we already have about 1 million clients across the various products that we have. The recent business we bought, Simple Tax, did about 800,000 Canadian tax filers this year. It'll do over 1 million next. And so simply optimizing kind of the channels that we have, we think can get us to a few million. Going from 3 to 10 will be the next challenge, but we can wait on that for a couple of years to figure out where we go next.
Hopefully no one notices us until we get to 2-3 million. I mean, it's interesting because talking to the founder of Tangerine, he basically explained that nobody paid attention to him until he had 2 million customers. I think it's really important not to be the fly in the ointment that all of a sudden people just want to stamp out. I think we have a tremendous amount of runway in clients that are fundamentally not desired by a lot of the larger financial institutions. And I think we have years before we go that. I mean, for our group, it's fascinating because Investors Group has had 1 million customers for a decade. We've not grown our customer base, we've not trucked 1 million. If you look at just Wealthsimple has added 1/4 of our customer base on top of that in 5 years when we've struggled for decades to grow. And so it's interesting how if you layer these services and the spectrum of services one on top of the other, you could actually start reaching a lot of Canadians.
Are you offering lending products as well?
Not today, but absolutely it's an area we'll explore.
Yeah.
Sure thing.
My question is, you explained how you got to Wealthsimple through a series of happenstance and et cetera. As a family or as the whole conglomerate, are you seeking out disruptors? And if so, how?
Yeah, great question. So the question is, you know, we bumped into Wealthsimple by luck. As a conglomerate, as a family, are we seeking out disruptors and how? And so I often tell people that 90% of my success has been luck, but I spent a lot of time positioning myself and preparing myself for luck. And so I got lucky to bump into Michael, but I knew the sector cold by the time I bumped into Michael, and I knew to jump onto the opportunity. And I'd actually already interviewed most teams in the kind of digital wealth management space at that time. And so, you know, how do we kind of seek out disruption? I mean, I'd say we've done it in a super industrialized process. So we did the Wealthsimple investment, which was the first investment we'd done in the space. I quickly saw that there was a lot to learn from these types of investments. So we then proceeded to make 6 more fintech investments, and then ultimately founded a fund called Portage, which is now the largest fintech investor in Canada by far. We manage just over $700 million for 28 institutions have a team of 15 people around the world looking for these kind of opportunities, and we are one of the larger players in early stage fintech globally. And so that's basically the approach we've taken. I mean, that's kind of, taking a bazooka to the kind of problem. But the service we provide for all of our LPs is one where we provide them insight on everything going on in fintech. And what we found is that by having an open ecosystem where we share all of our insights, not only with our own companies, but in many cases our competitors, where we have a lot of our competitors that have actually joined our fund as well, that gives us a competitive advantage because then they share information with us, they adopt our solutions, we have this great ecosystem going, and we think that that gives us a real advantage to at least win in Canada, but hopefully give a new energy to our group to win globally.
You've been.
Sure. So first and foremost, congratulations on your success and growth. It's been amazing to watch. Secondly,
Thank you.
I would like to ask your view exactly what the Greyhawk partnership is and how that works into Wealthsimple.
You want to take that one, or you want me to?
So it's interesting. I mean, Greyhawk is exactly the type of company that is disruptive in the high net worth space. It's extremely low fee, 50 basis point core fee, diversified portfolio with a large amount of the portfolio and low cost beta, ultimately giving you exposure to the market in a low cost way with a certain allocation to alpha that is explainable through kind of alternatives that are proven and have track records. In our mind, that is the future of high net worth management in the country. And so associating a Wealthsimple brand to a Greyhawk, really, really interesting. But ultimately, the portfolios that Greyhawk provides, it's really only the 60%, 70% of passive that Wealthsimple is a kind of technology solution for, but so is NBIN, or so is Canaccord. There's a range of providers there. But today the Wealthsimple platform is not set to really service that more complicated alts space, which I think is actually a really big opportunity in the wealth management space and in the technology space as well, is to bring kind of solutions like Addepar, things like that to the Canadian market. I think will be very kind of transformative. And so that's kind of generally the way we kind of think about it. The partnership was really an exploration of technological collaboration for the passive part of the portfolio.
You mentioned the importance of alignment between the investor and the portfolio companies. Are there any special ways that you structured the Portage fund with that long-term vision in mind, and how difficult was it to find the institutional investors to match you in that vision?
So the question was, how do we structure the Portage fund to match the long-term nature of investing in the space, and how do we find the institutional investors to invest in the fund? Portage is a 13-year fund, so it's a longer-term fund, and in venture world, 13 years is like dog years. I mean, we've been at this for 5 years or 4 years in terms of partnerships, and it's been like, it's been a while. But in the case of Wealthsimple, it's in an evergreen vehicle, and so we're planning on being shareholders for a very, very long time. The way we found our initial partners in Portage, our second Portage fund, is that we actually have created a lot of fintechs from scratch in Canada. We've built the largest telemedicine company in the country called Dialogue. If any of you are looking for telemedicine services for your companies, use it, it's amazing. Nesto, leading digital mortgage service. Breed Life, leading life business. We've launched Collage, which is an HR app. All these companies we've built from scratch through our incubator. And to scale those companies quickly, our team actually went out and called a whole bunch of financial institutions and tried to get distribution agreements, partnership agreements up and running quickly. And what we actually found is that we were more effective at getting partnerships off the ground with competitors and peer companies than we were with our own group companies. It's often harder to work with a cousin or a brother than it is to work with a stranger. This was the perfect case of that. And many of you, I'm sure, will relate to that in this room. And so when we decided to raise Portage 2, we basically just called all the financial institutions that we'd done operational partnerships with, and we said, hey, we're launching this fund. Do you guys want to participate? And basically 7 out of 10 times they said yes. And so we basically have brought together most of the middle market financial institutions in Canada in Portage. And then once we had that base, we went to the largest insurance companies in France, in Israel, in the US, and they kind of jumped on the bandwagon as well. And then finally we had big Canadian pension funds who were like, hey, this is cool. We own a lot of financial services companies in our portfolios. Maybe if we're investors in these things, we're going to learn a lot. And so it's as simple as that. And you know, we'll see. It's a risky space, and you know, I often tell people it's an adventure in fintech, and the reason why it's an adventure is we have no idea where it's going to end.
And on that note, is the other thing turned on? And on that note, have this on? No?
I could translate if you want.
I'd like to thank Paul and Michael for joining us today, for taking time out of their busy schedule. I know that we could continue this conversation for a long time. I've been in the financial services industry for 40 years, and I can tell you this type of disruption and innovation is long overdue. So congratulations, and we wish you great success. We have a small token of our appreciation for you joining us here today.
Thank you. Thank you. Thank you.
Very kind. Thanks so much.
Thank you. Thank you.